Hi. In light of everything that's been going on with Russia, the Ukraine, and the markets, we really wanted to take a moment out of our day to talk to you a little bit about where we think you should be in the market, where you can position yourself to hedge against all of this volatility. Doug, do you want to start us off? We have here Dorsey Wright, our technical analysis tool that we use that helps us know where to be in the market.
And it's measuring what's actually moving up and what's moving down right now.
Mm-hmm.
So you can see all the way up until recently, domestic equities were in the lead, and now it's switched over to where commodities are the top place to be. And
I think you told me that this is one of the first times that you've ever seen commodities on top, right?
Yeah, first time since we started using Dorsey Wright, and the last time I actually remember this was probably back in the 80s when, commodities were the place to be in.
Mm-hmm.
So you're correct. Yeah, it's a very unusual situation. And then we see international equities and then fixed income. So really, bonds are not that attractive, the fixed income. And what we're going to really focus on today is really where you want to be going in commodities, domestic equities, and international. So right here is crude oil, and what we're seeing here is crude oil has moved up rather strongly.
Mm-hmm.
It's a little bit on the over bought situation, so I'm not so sure I'd be rushing into crude oil. You might want to
Meaning
have some.
so many people have bought in that now the price is elevated. So if you buy at this particular moment in time, you might be at the top of the price.
Correct. Yeah. Now, what you might want to do is have a little bit as a hedge, and that's what we've been telling clients.
Mm-hmm.
No more than 10% of your portfolio, but it's not something that we think is going to go up a lot more.
Okay.
And this, of course, is looking at overall commodities and what's happening. And what we see here is that commodities have really had a big run up. We still think there's money to be made in it, but they are, again, overall overbought also, as you said earlier. It's
really striking to see where that line is on the chart, because you can see it's never been that high. Going back to 2007 is the first date on this chart.
It'd be interesting. We should actually take some time and see what was going on in 2000. Well, 2008 was the big downturn in the market.
Mm-hmm.
So it'd be interesting to go back and see why were commodities doing so well back in that period too.
Mm-hmm.
Have here is the financial index, and that's the number 2 sector to be in if you look at the dolly. And
Mm-hmm.
what we can see is it's actually in the green area, so it's a good time to be buying financials. We can actually look at individual financials or funds if clients were to call in and talk to us about it.
And define financials.
These would be your banks, stock brokerage firms, investment banking firms, insurance companies.
Okay. I mean, we do see a little weakening, though, in that area, right? These O's represent it going down a little bit.
Well, I would call it consolidation, and
Mm-hmm.
if that breaks to a column of X's
Mm-hmm.
up, that would actually be kind of like a catapult or triangle out kind of formation. So that would be a really strong buy opportunity.
And why are financials stronger right now? Like, we know commodities are strong in part because oil prices are going up and the price of food like wheat is going up because the Ukraine and Russia are big wheat producers. But what about financials?
Well, let's think about that.
Well, interest rates are rising, right?
Well, they've actually gone down, which we'll actually see that. Now, the Fed wants to increase interest rates.
Mm-hmm.
An increase in interest rates would be good for financials. So probably the answer is that the financials are anticipating, even though short-term interest rates have gone down, they're still anticipating interest rates to go up.
Right, because the market's kind of looking out usually. right, to what the market thinks will do well
in the future. It's looking to the future, and that's always something that people have a hard time understanding, that the market's predicting the future,
or at least trying to.
Right.
And this one is technology, so we can see what technology has been doing. Just an index fund of technology.
So what would you say it's doing right now?
Well, that's your Hawaii 5-0. That's we see it going down. It's had some weakening, although you can see a column of X's at the end here where it's kind of coming back up. It's flirting with going back in the right direction.
Just to review, the Hawaii 5-0 thing is the curling of the wave that you see at the start of the show. And that's always a classic sell signal.
Mm-hmm.
And but I would say right now it's not quite time to buy technology type companies. But if those X's continue to move up, then I would say we want to be ready to go into that area.
And I mean, you see like the prices go back. I mean, at this bottom, the prices were down to where they were back in June of 2021. I mean, companies like Google, that means they're in a place where they, might be arguably a good time to buy too.
And if we put our fundamental hat on versus our technical, it's a great time to buy quality technology companies at a low price.
Mm-hmm.
So. And then this is the other thing we're seeing in the international areas, although around Ukraine and Russia, it's not a good place to be investing internationally. We're starting to see, as you get further away, some attractiveness in the Latin America area, as we're seeing here, which just gave another buy signal.
Mm-hmm.
And then on parts of Asia too, there's some attractive areas to be getting into.
And I think some of these, with the Latin America funds, they have a lot of metals, industrial metals inside of them, right? Which are important for...
Well, you're right. A lot of those companies are commodity based,
mm-hmm.
Not just metals, but also, for example, coffee and
mm-hmm.
that kind of stuff. So commodities are doing well. So we're also seeing the companies that are involved in commodities in countries that rely a lot on commodity stuff. Good point there. And this is reflecting, the blue line is looking at the further out back in February at the interest rate yield chart, the curve, and then the gray line is early March, the 1st of March. And what we can see is short-term rates are actually going up, and long-term rates are kind of going down, so it's a flattening of the yield curve. It's still it's not a yield curve that is going, when you see long-term rates actually lower than short-term rates, that's a sign of going into recession. So we're still in a healthy economy, that's what it's reflecting, but we think long-term interest rates will continue to go up, and that's going to be difficult on bonds. So we're not real positive on fixed
mm-hmm.
income or bonds.
I think that's all for our charts, Doug. Any parting wisdom?
Well, I think in every crisis there's opportunities, and what we want to be doing is looking for the opportunities in this situation, and right now we're seeing it currently in commodities, in banking and financial companies, and we think not very far down the road we'll be seeing it in technology, and also some overseas markets are attractive like Latin America and parts of Asia.
Now, would you suggest that someone sell and lock in some of their losses right now in order to move into these areas, or? Good
point. No, I don't think. Well, we should look at it individually with each client.
Sure.
But there's a lot of quality stuff that you have losses that you don't want to sell out of mm-hmm. right now. For example, technology would be a great example. I wouldn't be selling out of a great technology company just to buy something that's moving up, like say oil that's extended.
Right.
I definitely wouldn't do it at this time.
Right. But if you have some cash on the sidelines, you could buy into one of these sectors as a hedge.
Exactly. Yeah. And we would be happy to work with each client individually and suggest where they should be adding this money into.
So that's a little bit about where we see the market as of today. As always, please give us a call if you have questions. Thanks for watching, and we'll see you next time.